Whether you're a bank, an insurance company, a non-bank financial institution, private lender, not every loan is going to work out. And anybody who says different is just not being 100% forthright. Give us an example of a transaction that did not go as anticipated, maybe became impaired or even foreclosed, and how you guys handled it, what you learned, and what the future holds for situations like that.
The first thing is you have to have a proper quality control feedback loop. And that feedback loop allows you to take a look at when you complete a loan, whether it was a loan that worked well or a loan that worked poorly. What is it that happened? What worked well? What didn't work well? And how do you make sure that those things that worked well, you leverage those so you do more of that? And those things that didn't work well, you're honest with yourself and you take a look at what did go wrong and how can I do that better? And you feed that back into the origination process, the due diligence process, the servicing process, so that hopefully doesn't happen again. There was a recent situation where we had a loan that did go into default. It went through workout. It took probably 2 years to go through the full process. But because of how we originate the loans and how we built in default interest and how the fees get covered off and how we value the property at the outset, how we control the cash flows, it meant that we were able to control a lot of that risk until we got to the point where we were able to liquidate the asset. So when the asset was liquidated and you take a look at what our original underwriting estimate was on what the return was going to be for that loan, I think the original underwritten estimate was about 22% return on equity for that loan. And I think we had about a 21.7. So even with everything that went wrong, we were able to control that process and manage it in a way where we were still able to get almost to the same point that we thought we would in 2 years, but we did it in 4 years and delivered the same sort of return.
So this begs the question, if I'm an investor sitting across from you and I say, okay, you were supposed to have an 18-month loan, now it took 2 years to complete, how in the world did you keep accruing interest? How are your investors getting that kind of return even though it was extended by 1.5 years or 2 years as you indicated? There must have been a tremendous amount of equity in the transaction.
There are a couple things, and this kind of comes to the way we underwrite the loans in the first instance. So we use what's called a Dutch interest method. And what that means is, let's say that you're going and you're buying an asset which costs $5 million. And you think that once all the refurbishment work is going to be completed, it's going to be worth $10 million. But in order to realize that $10 million at the end of that time period, you have to spend $2.5 million in order to get it brought up to snuff. Well, what we do is we will lend the $7.5 million on day one, but we will only allow them to take, say, $4 million in cash out of the transaction, out of our loan on day one, which allows them to buy the asset. So they still have to put $1 million of equity in there. So effectively, they're borrowing an 80% loan to value at that point. Then as they start the work, we will allow them to get the disbursements from the escrow, which allows them to pay for all the work that needs to be done to realize that refurbishment work. So now you're seeing that value start to increase as they're completing that refurbishment, and the value is getting closer to that 10 million. By having the proper servicing process in place, it allows you to identify when problems start developing early. So if a problem starts developing early, you can start taking action which limits your exposure to them running off with the money, paying the contractors inappropriately. So it's having those types of controls that are in there to ensure that that doesn't happen, so that as you go through that process, you're able to have enough equity value that's been created in that asset, which allows you to get a positive recovery and support being able to get that type of return and satisfy your investors ultimately.
That brings up another question. So how do you know when the contract, when a sponsor, a person we're lending to, how do you know when they request money for that, in that particular instance, for new flooring that went in? How do you know that you're paying for the flooring? Like, how are you controlling that? Because I've heard horror stories of contractors doing questionable things.
It happens. And so what we try to do, and we had an instance of this relatively recently, where a contractor attempted to put through invoices that weren't appropriate. So what we do is, before we even lend on the loan, before we provide that initial advance, we bring in a firm that specializes in assessing what that cost structure is for any work that needs to be done. They do it much more on the construction side of the business than they do it on refurbishments. But we bring them in to go in and do an assessment of how much is it going to cost for someone to go through and do that refurbishment? How much are those new floors going to cost? How much does the new sanitary ware for a bathroom cost? What is it going to be the cost of labor? And so they'll go through and do that work, and they will provide us an estimate of what that is, which we can then go and compare to what the borrower is saying it's going to cost them. Wherever we see any differences, we'll try to get a reconciliation between the two so that we feel that we've got a full grasp of that. It doesn't end there, though, because once the loan is closed, that same firm that has done that work initially, they're contracted to go through and check what is being spent on that asset, what parts have been ordered, what inventory has been ordered, what equipment is being used, what the labor costs are, so that we know that every time that someone is asking for a disbursement from us to pay those costs, we've got a reconciliation to make sure that those are the costs that are actually being in there. People will try to go and spec out the finishes for a building and put in the highest quality finishes, and they'll represent to you that they're getting the highest quality marble, which will cost you an arm and a leg to pay for. And then they go and put in laminate floors. So this type of works ensures that you don't have that misalignment in terms of what's being reported that is being spent and what's actually being spent.
So in essence, you guys are doing construction, or the team is doing construction draw audits.
Similar to it.
Okay.
It's not construction, but it is similar to that, so that we can limit that sort of downside risk.